There are many tax benefits to owning real estate. Today, I'm going to share with you one of the most powerful ones that'll reduce your tax burden to $0. Many of you have probably heard how people make a lot of money and yet they don't have to pay a lot in taxes, or sometimes they pay nothing in taxes. I'm going to show you one way that these people do this through real estate, and it's called depreciation. Real estate depreciation is a method used by property owners to account for the wear and tear or aging of their property over time. As buildings and structures become old or outdated, they may lose their value, and real estate depreciation allows owners to track and reflect that change. So technically, this term in real estate means that things on the property are going to break down and you're going to have to come out of pocket to fix these things to keep things updated and modern and current. And the government wants to incentivize investors to make sure they're taking care of property, to make sure that they're investing in buying property so that people can have housing. And so they incentivized us as investors through this depreciation tax code so that we can get a relief from that. Now, this is not to be, confused with the term appreciation in real estate, which means that the values of real estate go up over time. That is still true, and that is still a benefit of owning real estate. But the other benefit is depreciation, and this is where you can recoup a lot of tax savings so that you can then reinvest into the property or reinvest in new properties, save money, and buy more, which is what the government wants you to do. So now that we know what depreciation means, let's go through how it works. First of all, you can only depreciate the value of the building. You cannot depreciate the land that the building sits on. So, for example, if you buy a property for $650,000, that's what you pay for it. You're paying for the land and the building. But when it comes to depreciating and getting tax benefits, you can only write off the value of the building. Usually the best way to dictate the value of the building and the structure itself is through the real estate tax assessment that you can pull from the town or city that you're in. This is going to give you the value of the land and the value of the building, and you can take that ratio, that percentage from the tax assessment and use it and apply it for your accounting purposes when it comes to tax time. And this is when it would be a huge benefit to have a CPA or a tax professional that specializes in real estate investments so that they can help you with these tax write-offs. So let's go through an example now. So here we have the property cost of $650,000. We determined that the land cost is $150,000 by looking at the tax assessment, and that's about 23% of the overall value. These are going to change depending on your localities, but for the example here, that's about 23%. So we take the land cost subtracted from the total cost that we paid for the property, and we have the house cost or the building value of $500,000. This is the basis that we're going to use, this $500,000, to dictate now how much of a write-off we can get. Now, keep in mind that for residential real estate, you can divide the total value of the building by 27 and a half years. Commercial is going to be different. Commercial is 39 years. But for residential, single-family homes, we are using 27.5. So we're going to divide $500,000 divided by 27.5, and that gives us a total of $18,182. This is our annual depreciation write-off for that year. What that means is if your rental property made $18,182 of profit in that year, based on those numbers, you would have zero tax liability for that rental income. If you had made more than $18,182, the difference between your actual profit and the $18,000 is the only amount that you would be taxed on. And you would have, your regular tax bracket, let's say it's 25%. That amount would be taxed between the 18,000 and the amount that you made that's over that. If you made less than 18,182 in that year, you would actually have a tax credit. Okay, that credit could be applied to another rental property that you own. It could be deferred to another year, and you can take the benefit in the next year. So this is actually something that you can do that's extremely beneficial to save money. So you're not actually paying any taxes on most of, if not all, of the cash flow that you make from a rental property. So this annual write-off, remember, is dictated by the 27.5 years. This is the amount of years that the IRS has allowed for with residential real estate. But imagine if there was a way to accelerate that, right? This is divided by 27.5. What if we could do that by 5 or by 3 years? We would have even a bigger write-off. There is something called accelerated depreciation, and you can do this through what's called a cost segregation study. This study costs a lot of money to do, but if you need the tax benefits and you have a lot of income you need to offset, it could be worth the investment in doing the study. They just come in, they have some engineers that'll come in and basically look at all of the individual parts of your property and say, okay, this thing here, we think this will deplete in 5 years. It's only got a useful life of 5 years. This over here, we think will last 7 years. This, 3 years. So they take all of these parts individually, and then they give it a useful life, and they come up with a final useful life that you can use and divide by that number, which will give you a huge write-off in the first year that you own the property. This is a lot better than just doing a whole general 27.5 years, and that is one of the ways that you can save even more. So depreciation is an awesome benefit to real estate investors, but believe it or not, there are many other tax benefits as a property owner, being 1031 exchanges, where you can sell your property and roll the profits or proceeds into a larger, bigger property and pay nothing in taxes on the sale. They have cash out refinances, where you can pull equity out of the property you own tax-free. You take that cash, you hold on to the property, continue to rent it out, and you have this bundle of cash now where you paid no taxes on it. Mortgage interest deductions and repairs and maintenance that you can write off. We can go into more detail on these benefits in another video. Today was mostly about depreciation. Thanks for watching today's video. Please like and subscribe to the channel. It helps push this video out to other people who will benefit from this information. Have a great rest of your week. Remember, keep going, keep learning, and keep grinding.